following the decision of the Central Bank of Nigeria and its monetary policy rate. That's to increase the rate. The maximum lending in the banking sector has increased to 28.75% in February, translating into high cost of borrowing by bank customers. The maximum lending rate for Nigerian banks rose to 29.13% in December 2022 from 28.14% recorded in the previous month and 27.58% in the corresponding period of 2021. It will interest you to know that lending rates increased on the back of multiple rate hikes occasioned by the Apex Bank in 2022, specifically as the CBN raised the benchmark interest rate by a collective 500 basis points in 2022 to 16.5%, representing its highest rate in 21 years. Well, let's discuss more on this as we assess the implications of this development on businesses and the economy at large. I'm being joined by a global economic consultant, a development economist, public policy analyst, Professor Ken Ife. Prof, it's always good to have you on the show. Good afternoon.
Thank you. Thank you for having me.
Well, Prof, already the discussion is around this increase that we see in lending rate to customers, which seems to be on the high side. 29.13% is what we've seen. But can you explain to us how we arrived at this? Because for a layman, he would understand that what the CBN says is 18%. But we know there are other things that are involved in this for us to get to these figures. What really are the banks going through at the moment, talking about lending to customers with this figure that we have?
Okay, in most foreign economies, advanced economies, when you see an MPR rate, a monetary policy rate of about 18%, normally they would expect a markup because that is the rate at which the central bank lends to the commercial bank. So that's the base rate. So what happens is that they have to put some margin on top of it. In very advanced economy, people will expect about 2% margin or 2, 3, 4% margin at the most. But in Nigeria, you're looking at 11%. Now, what happens is there are other things you have to take into account. One is how is the banks, how are their costs? What is the configuration of their costs? First of all, you see electricity they have to provide for themselves in most cases because they fall into the 68% of the companies who say that they provide power 90% of the time. Then you have all of the infrastructure, for example, broadband infrastructure, telecommunications. They have each ATM costs them about minimum of 250 to 300,000 naira per one to maintain one every year. So they have all that kind of costs. And not to talk of transportation costs, not to talk of human resource manpower costs. So they have all of that. But the second aspect where I sympathize with the banks is that quite a lot of their capital are sequestered. For example, 32.5% of their money is actually sitting sanitized in the central bank vault, sitting there as a cash reserve ratio. And that doesn't earn them a penny. Although we do have a CBN scheme that tries to encourage them to lend on differentiated cash reserve ratio. So pulling out some of that money and putting it to medium-term investment. Then they have 30% liquidity ratio. So they have to maintain 30% liquidity in all cases, because if you look at what is happening to Silicon Valley Bank, it's just a classic case of high interest rate crossing its path with low liquidity risk. So you now have the two risks clashing. Now, the banks that are supposed to maintain a high liquidity they happen to maintain low liquidity, while at the same time taking some of the customer deposits, because customers deposit short-term money, small deposit accounts, that's short-term. And then you see that a bank carrying that short-term money and investing it in long-term instrument, taking a risk on liquidity. And now when the high interest comes up, people now want to get their money to pay for the high interest. And this high interest could come from a sudden spike in the rates of electricity. You have fuel and gas increasing up. People want their money, mortgage rates going up. Well, that's great. And then you see all the cost of food in the market, everything going up. So they want to pull down some of those their short-term deposits to pay for all these increases, and they can't find it because the bank has invested them in longer-term instruments. So that's why they went to the gutter. And Nigerian central bank wouldn't let that happen because we've been beaten twice. Before what happened in 2008, which wasn't similar to this, but it was from America subprime mortgage crisis. So we responded because we had money. We had about $62 billion in foreign reserves, and we had $22 billion in excess crude accounts. So the central bank governor then had money. So he could now set up AMCON and gave me $6 trillion to go and buy up all these debts and securities from the banks to bring back liquidity to the banks. So, and that's how we averted that major crisis. And let me tell you something. Banking crisis, systemic banking crisis are far more dangerous than simple stagflation and recession. They're far more dangerous because don't forget that the bank keeps money of itself, which is its equity. It takes deposits from people. It lends money to the manufacturers, to the producers, to the buyers, to the retailers. So it has a complete grip on the economy. So you do anything and everything to avoid the financial system collapse. And that is a primary objective of any central bank. Then, of course, you have the price stability as the second objective.
Interesting stuff, Prof. But I will follow up with a question that every Nigerian will want to ask. What's the level of stability? We saw Moody's downgrading at a particular time. What does this mean for our banking system, and how stable would you say we are at the moment?
Well, what I will tell you is this. A lot of so many measures of stability of our financial system. For example, we know that capital adequacy ratio for our own is quite high at 15%. And most of our banks are cruising at around that same level. You could see that today, or was it yesterday, Ghana Bank, the central bank, stepped in to want to push the commercial banks to move capital adequacy ratio from 10% upwards, which shows that we are comfortable where we are. And then you have the non-performing loans, which the prudential guidelines put at 5%. So again, most of the banks are around that 5%, even though they have so much exposure. Many of them have exposure to the likes of Anchor Borrowers Program and some other debts, and even some of the loans in 2020 that we are giving to improve liquidity during the crisis. So even then, they are still all around the same prudential guidelines of 5%. So you take all that together, and the fact that there's also the solvency situation created by 30% liquidity ratio and 32.5% cash reserve ratio. And even some of them also responded to the increased loan to deposit ratio, which went from 55% to 60, 50 to 55 to 60%. Quite a few of them went up in that regard. So I wouldn't say that there is an imminent danger. But having said that, don't forget too that some of them are exposed to lending to the public sector. And the public sector at the moment has a lot of excess baggage when it comes to lending. So some of the commercial banks are exposed in those. In the 2008, it was more to do with the oil services company. They were overexposed to the oil services sector. And so they took a hit because the revenue from there dropped by about 60%. So there was crisis, endemic crisis in the financial sector. But it's not quite the same now, even though we are still experiencing high inflation and quantitative easing have ended, and investments are not coming in as you would have expected, compounded by insecurity. So it's not a huru yet at all for any of the players. The risks are still high, and these risks are more exogenic than endogenous. Endogenic in the sense that if you look at the global crisis, the American and Chinese trade war has not abated. And that's over $700 billion in trade there, hanging there. Then you have the Russian crisis. Again, that nobody could even tell where that is going to go. When you think there's going to be some claim, now it's gone off often. Then you've got the 2020 COVID-19 fallout. And that has pushed so many economies to borrow so excessively And even many central banks, like our own as well, also had to give overdraft to government. And so all of that means that we have a lot more to mop up in terms of both the liquidity in the economy itself, but also in reducing the impact of high rise in interest. The higher interest is making them pay more for service, for debt service. And that means that government has less money to spend on capital, which is where jobs are created. And then sudden increases in interest rate also reduce the appetite for investors to invest or to borrow to invest. Again, that hits the banks because bank is the primary receiver when it comes to are you giving money to banks, to businesses to expand, or are you going to receive more transactions revenue? Or are you going to, so the bank suffers. The bank is the common denominator in all aspects of the economy.
Well, let me follow up with the fact that many will expect lending from the banks. But when we look at all of this breakdown you've given us, we see that it's not very easy. And there's some sectors that the bank will always term as being high risk, very risky sectors for them to lend to. Now, what do you think, or how well do you think these banks, how are they performing with regards to risk management? How can they manage their risk properly? We know what happened with the oil and gas sector, some power sector deals that didn't come up well. How will the banks manage challenges like this, or how are they managing challenges like this one?
Well, it's not so much at the level of individual banks, but more to do with the regulators' approach. Because if you look at the prudential guidelines, it focuses a lot on risk management, enterprise risk management. And then we have also a risk-based supervision. And they are constantly being supervised by the banking supervision department. And so they look at all aspects of their risk. That's why I pointed to you some of the ratios that the central bank uses when they are out there looking at their books and then breathing down their necks to ensure that, because as I said, central bank has to have acrobatic mentality to work with the kind of banks that we have that quite often veer in different directions. So obviously there are traditional sectors that banks don't like to lend to. For example, agriculture. That's why agriculture has to be de-risked considerably by central bank using nicer instruments. But there are others too, solid mineral. I don't see how they will be lending to them in this current dispensation. And then they know the banks normally want to lend to traders that do short term. They borrow today, a month's time they pay, and they charge them very high rates because they borrow for very few, 1 or 2 months, at the most 3 months. But that cannot be said of manufacturing sector. So the manufacturing sector suffers the most, because you can't come to manufacturing sector and give them loan at 29%. What do you mean? How can they pay that? And what moratorium are you going to give them? How about the rising cost of raw materials? So it's difficult for commercial, for banks, for manufacturers to go to commercial banks for the kind of lending that they require. So who goes there are traders, and you know where these traders are coming from. It's all to do with Russia and China. And look at the trade balance. You saw a huge trade imbalance because of the trillions that we are losing because of our deficit, the trade deficit. And they can afford to borrow that kind of money at that rate.
Take you back to the 18% MPR, which is where we stand at the moment. The CBN says they will continue to increase rates to rein in on inflation, but it seems not to be working. You always explain to us the issue of the supply side of inflation that needs to also be addressed. What really is the issue? Would we just continue to increase this rate while inflation still continues to go haywire?
Well, the thing is that, there's conventional wisdom, and then there is an issue that the world is facing stagflation. You see, all the central banks around the world, they know how to deal with recession. And all of them also know how to deal with interest rate rises, inflation. They know how to deal with inflation because that's their traditional mandate. But what they don't know is how to deal with stagflation. Stagflation is where, inflation that is supposed is going up at the same time as growth going down, it's going into recession. They're moving in different directions. They're not used to that. So, and the causes of this kind of phenomenon is more exogenic. In other words, it's not really within the boundaries of the national boundaries. So you are now looking at why is it that the event in Russia and Ukraine is affecting us more. It's pushing up the price of gas, it's pushing up the price of oil, it's pushing up the price of wheat we use for bread. Some are using the wheat for bioethanol in Europe. Then the trade challenges between China and India are also affecting. And then you have the fallout of rising huge debt. And when you have debt that are huge, think about it in terms of repayment obligation. And that repayment has gone up because over 60% of world debt is denominated in dollars. Now, dollar rates are going up, inflation is going up. All that in the whole world is paying for all those rise in inflation and the interest rates in America. We're all paying for that. And it's all coming from the increases that are going to come on the money borrowed in dollars by our countries for building our economy. So all of those are actually exogenous. But then when you look into the country, you will see issues that are structural, issues like, oh, the electricity price has gone up, the water rate has gone up, every rate is going up. The transportation cost, the diesel is gone up 400%. All of those are internal structural factors. And then you have insecurity to compound in everything. You know, that those who would have had to invest in your economy to help ameliorate are just running away because of insecurity. So when you have a combination of these two, then you are going to see that the fiscal policy, which used to be getting universal traction, you know, if you look at multilateral, bilateral, and plurilateral trade agreements in the world, and many of the things happening on regional integration are all around the fiscal side. But monetary side is different. So for the first time now, the central banks need to be talking to themselves across the world. They need to be looking for common grounds. They need to be seeing how they can, you know, synchronize the fiscal and monetary policy so that we can get more traction on that aspect. And that is the way we're all failing.
Finally, Prof, what is the outlook, particularly for inflation, moving on in a few months?
Well, the inflation, well, you know, food supply tends to affect it a little bit, to bring it down a little bit. And we're having the harvest. We are affected badly by this, by the last storm. What do you call it again? The flood. Flood affected us. Over 200,000 hectares of food lost. But we're recovering, and we are going to have an early season, which is, as you can see, the rains have started coming. So on that particular side, there may be some scope for recovery. But in terms of the inflation figure itself, we've also thought that maybe the issues around monetary policy, and especially all this whole changing of Naira, may even have had an impact, but not as much as you would have expected. So, you know, give and take, I think we'll still have to live with this inflation for quite some time. At least in the next 3-4 months, we will still be staying a bit steady and not going high, that high. Not anything like Ghana. Ghana is 58%. Nigeria is just 21%, just less than 22%. But we're a very, very resource-rich country, and that's what is helping Nigeria. Otherwise, we would have been running at twice the inflation that we are having right now. But we are resource-rich. So whatever happens, people still find a way of making a living in one way or the other in some area. But don't forget again that over 100 million francophone countries, member states are shopping with Nigeria, and creating demand pool inflation, food inflation. So it's not very easy. It's not a very easy issue to deal with in Nigeria. But as I said, it's not insurmountable. We could have increased productivity because as you may see, the insecurity hasn't degenerated that badly, at least in the last 2 months, to affect the planting season. So if we could just hold our line and then have more planting go on in the next 2 months, then there may be a different picture.
All right, then I must thank you for your time. Now, I've been speaking to global economic consultant, development economist, Professor Ken Ife. Thank you so much. Do enjoy the rest of your day, Prof.
And thank you. Thank you for having me.